By increasing the derivation component of VAT to 60%, the administration has effectively ended the era of rent-seeking, a behavior where states relied solely on oil windfalls. Now, every geopolitical zone is incentivized to improve its business environment to attract consumers and businesses alike. This simultaneous pressure and support, protecting the poor through a 800,000 naira tax-free threshold while demanding more from high-earning entities, has created a more resilient national economy. The result is a Nigeria where the North finds strength in its agricultural tax shields, the South thrives through industrial efficiency, and the East grows through SME formalization, all contributing to a unified revenue base that is less volatile and more equitable than at any point since 1960. Under the 2025 Tax Reform Acts, the distinction between tax exemptions for business owners in the North and South is primarily driven by the sectoral incentive and small company frameworks, which align with each region's economic strengths. In the North, where the economy is heavily agrarian, business owners benefit from a monumental 5-year tax holiday specifically for primary agricultural production, crop, livestock, and dairy, alongside a 100% tax exemption on interest for bank loans used for agricultural fabrication or cottage industries. Furthermore, essential agricultural inputs like fertilizers, seeds, and equipment are now zero-rated for VAT, effectively lowering the cost of production in the nation's food basket. Conversely, business owners in the South, particularly in the bustling commercial hubs of the Southeast and Southwest, leverage the expanded small company status. Businesses with a turnover up to 50 million Nigerian nairas, and in some specific categories up to 100 million naira, are now exempt from the 30% company's income tax, the 4% development levy, and the requirement to register for or file monthly VAT returns. This is particularly transformative for the South's high density of tech startups and retail SMEs, which can now reinvest 100% of their profits into scaling operations without the administrative burden of withholding tax on their supplier payments. While the North finds its fiscal breathing room in long-term production holidays, the South's advantage lies in the input VAT recovery system and derivation-based revenue sharing. Southern manufacturers and service providers can now recover VAT paid on fixed assets and capital expenditure, a move that incentivizes the industrial modernization seen in the Southwest's free zones and the South-South's oil service sectors. Additionally, the shift to a 60% derivation-based VAT sharing formula ensures that the high consumption rates in southern urban centers translate directly into improved local infrastructure, whereas the northern states are cushioned by the Economic Development Tax Incentive, EDTI, which replaces the old pioneer status with credits linked to verifiable capital expenditure in underdeveloped areas. Ultimately, the 2025 laws do not favor one region over the other but rather provide a specialized toolkit. The North is given the tools to dominate global food supply chains, while the South is empowered to lead in industrial services and